So let's talk about the 2008 financial crisis. This wasn't just some random accident. It wasn't a simple market correction. No, this was a slow-motion catastrophe, a total systemic failure that had been building for decades. So today, we're going to unpack exactly how it all went down. Let's dive in.
Yeah, this quote really nails it. We're not just talking about numbers on a screen here. This was a complete, fundamental breakdown of the entire global financial system. Think about that. The trust, the very glue that holds our economy together, it wasn't just lost. It was deliberately shattered, just detonated.
I mean, for most people, right, this whole crisis felt like it just came out of a clear blue sky. One day everything's fine, the next, bam. Retirement funds are shrinking, your neighbors are losing their homes, and there's just this palpable sense of panic in the air. So to really get what happened, we've got to look past all that chaos and see the actual machine that was built to cause it.
Okay, so to get how this all went so wrong, we have to rewind the clock a bit, back to the early 2000s. Remember the dot-com bubble? After that burst, Wall Street was hungry, searching for its next big profit engine. And where did they find it? In the American dream itself, owning a home.
All right, here's our first piece of the puzzle. It's a fancy-sounding thing called a mortgage-backed security, or MBS for short. The idea was actually kind of simple on the surface. You take thousands of regular home loans, mortgages. You bundle them all up into one giant package, and then you slice it up and sell those pieces to investors all over the world. Suddenly, a home loan wasn't just a loan. It was a product, a commodity you could buy and sell.
So this new MBS machine was incredibly hungry. And to keep feeding it, the banks needed a never-ending supply of mortgages. Well, pretty soon they ran out of people with good credit. So what did they do? They just lowered the standards. And that brings us to ingredient number 2, subprime loans. These were mortgages given to people with, well, not so great credit, often with little to no proof of income and, this is key, with these risky adjustable rates that were designed to look cheap at first and then balloon like crazy later on.
And this is where the story gets really nuts. A third product shows up on the scene, the credit default swap, or CDS. Now, on one level, you can think of it like an insurance policy on those MBS bundles. But here's the twist. It also let people place massive bets that the whole thing would fail. It created this completely perverse situation where you could make an absolute fortune from widespread collapse. You could literally place a bet on the whole house of cards coming down. So you might be asking, where were the referees in all this? Well, that's the thing. The so-called watchdogs of the system, the rating agencies, were completely compromised. Their job was to independently rate how risky these products were. But guess who was paying them? The very same banks creating the products. It was a massive, glaring conflict of interest. And the result? You had bundles of incredibly risky, toxic loans being stamped with a perfect AAA rating. That's the safest rating you can possibly get. It's like putting a certified fresh sticker on rotten food.
So let's just lay it out nice and simple. Here's the recipe for disaster. Step 1, bundle thousands of these junk loans together. Step 2, pay a rating agency to call it safe. Step 3, sell this time bomb to investors all over the world who think they're buying something secure. And step 4, the final twist, take out your own side bets that the whole thing will eventually explode. It was a perfect, and let's be honest, a perfectly cynical machine.
So by about 2005, the housing market wasn't just hot, it was a full-blown bubble, totally disconnected from any kind of reality. And we all know what happens to bubbles, right? It was only a matter of time. And then it started. Those tricky adjustable rate mortgages began to reset, monthly payments went through the roof, and ordinary homeowners just couldn't keep up. They started to default. The music, as they say, was about to stop.
And then the dominoes fell, one after another. First, Bear Stearns went under. Then, in September 2008, the big one, Lehman Brothers, collapsed. And that sent a tidal wave of pure panic around the world. AIG, the huge insurance company that had insured all this toxic stuff, was about to go down too. Suddenly, nobody was lending money to anybody. The credit markets just froze solid. The whole system was in an absolute freefall.
And the human cost, it's just staggering. Just look at this number. Over $10 trillion. Gone. Vanished. And this wasn't some abstract Wall Street problem. No, this was real money. This was people's retirement accounts, their kids' college funds, their entire life savings just evaporated, almost overnight, for millions and millions of families.
Okay, so the system is collapsing. The government steps in, and the response is huge, it's immediate. But here's the really crucial part that our source material points to. You have to ask, who was this response designed to save? Because the goal wasn't to help the homeowners who were losing everything. The goal was to save the very system, the very institutions that caused the meltdown in the first place.
And this right here, this shows you the tale of two Americas that came out of the crisis. On one side, you've got Wall Street. They received trillions of dollars in bailouts. Executives still got their bonuses, the system was saved. And then you have Main Street. What did they get? Skyrocketing unemployment. Foreclosures just kept on coming. Very little direct help at all. Our source material calls us what it is, a profound moral failure. The system protected itself, not the people it was supposed to serve.
So let's fast forward. Here we are, more than 15 years later. The fire is out, the immediate crisis is over, but its ghost still haunts us. It completely reshaped our economy, and it left us with a whole new set of risks. Risks that, honestly, feel a little too familiar. Which leads to the big question. Did we actually learn anything? Are we listening to what history is screaming at us? See, after the bailouts, we entered years of this policy called Quantitative Easing, or QE. It's a bit complex, but the simple version is the central bank basically started printing money and pumping it into the financial system. And sure, that inflated the prices of things like stocks and houses, which felt good for a while. But it also did something else. It pushed debt, corporate debt, government debt, your debt, to all-time highs. It's left the system, you could argue, even more fragile than it was before 2008.
So, what are the big takeaways here? What are the lessons? Well, lesson number one is this. Complexity is not an accident. It's a tool. It's a feature, not a bug. Wall Street loves making things opaque and confusing, because if you don't understand it, it's a lot easier for them to hide the risks and sell it to you. It's basically a magic trick. They get you focused on the complicated stuff so you don't see what's really going on.
Lesson number 2 is so simple, but it's incredibly powerful. Incentives drive everything. If you run a bank and you know that if you screw up, the government will bail you out, well, why wouldn't you take bigger and bigger risks? Heads, you win and keep the profits. Tails, the taxpayer loses and foots the bill. That's something called moral hazard, and it was the beating, toxic heart of this whole crisis.
And that brings us to the final and maybe the most important lesson of all. In a system that's this complex and this risky, financial literacy isn't just a good idea, it's a survival skill. Look, this isn't about you needing to become a Wall Street whiz kid. It's about understanding the rules of the game, learning to question the official narratives, and always asking two simple questions. Who benefits and who's carrying the risk?
You know, the 2008 crash was a massive, painful warning sign about just how fragile our whole financial world really is. And it leaves us with this one big, lingering question. When you look around today, at the record levels of debt, all the new financial technologies, and the same old human behaviors, what do you think is the biggest crack in the system right now? What's the biggest risk we're all facing? I'm curious to know what you think.